After enjoying several months of steady gains, the stock market has recently shifted gears into a short-term correction mode. This shift has brought about a wave of anticipation among traders and investors about what may lie ahead next. The NASDAQ composite has gracefully pulled back to embrace its 50-day moving average for the first time in 4 months. This is a notable move that sparks curiosity about the implications for the broader market trend. On the other hand, the benchmark S&P 500 index has just slipped below key support of its 20-day moving average, an important short-term indicator. What does this correction mean? In today's video, we'll take a look at the charts and see if we can find out what may lie next. We'll also take a look at three hot stocks showing high relative strength that may be setting up for potential swing trade entry in the coming days. Don't miss out on these opportunities. We'll go ahead and dive in, but before we do so, be sure to hit the like button and subscribe. Let's start with a review of the S&P 500 index as a broad-based barometer of the overall market's health. Now, we want to focus your attention here on the 20-period exponential moving average, also known as the 20 EMA. That's this beige-colored line. Notice that since April, on this daily chart of the S&P 500, that the S&P 500 has held above this 20-period moving average for most of its uptrend. And you notice when the trend was just getting started back in April, we had a few dips below the 20-period moving average, but notice how each dip only lasted 1 or 2 days before the price moved back above it. And that's what's known as an undercut. And this is common when there's a new uptrend that's being developed. And once the trend got rolling in May, notice that the price action has stayed above it on every pullback for several months until just last week when the price action slipped below it. Now, what does that mean for the market? Well, first of all, markets don't move up in a straight line. Obviously they correct along the way. And is this a healthy correction? First of all, the 20-period EMA and the 8 EMA are two of the short-term indicators we use for trend. And now that the price action has slipped below those levels and not snap back above it, both the 10 and 20-period moving averages will now act as resistance. The most basic tenet of technical analysis states that a prior level of support becomes a new level of resistance after the support is broken. So this range right here, around 4,500, where the 10 and 20-period moving averages converge, is going to act as resistance. So in any rally attempt, watch this level right here carefully. We need to get back above 4,500 and then above this little shelf of resistance here at 4,520. If we do, then we can see bullish momentum start to pick up. But until then, market may have a little bit of a tough time. Another possible scenario is that we could see a continued pullback down to the 50-period moving average, which is a more important indicator that we'll dive into when we talk about the chart of the NASDAQ here in a moment. So let's go ahead and look at the NASDAQ. The NASDAQ composite has a similar chart to the S&P 500 in that it's also been in a steady uptrend since April and has only undercut its 20-period exponential moving average just a few times, just like the S&P 500. But notice that the NASDAQ composite is actually showing a bit of relative weakness to the S&P 500 in that it's already pulled back to test its 50-period moving average, 50-day MA, this blue line. Now, the 50-day moving average is a really important indicator for intermediate term trend. This is an indicator that's used by institutions, banks, mutual funds, and hedge funds that tells them if a stock is in a steady uptrend and it pulls back, the first touch of that 50-day moving average in a fundamentally strong stock often triggers institutional buying. And so this is a closely watched indicator by institutions. Likewise, if we're in a downtrend, when we rally up into resistance to the 50-day moving average, that's also significant resistance. So we'll be watching the NASDAQ closely here in the coming days and how it responds on this test of the 50-day moving average. We may get an undercut. That's a possible scenario where we dip below this level significantly and wash out stops. And then we want to see the price rally back above that 50-day moving average within 1 to 2 days. That would be bullish if we get that scenario. So we'll be watching this carefully. Just like with the S&P 500, the 10 and 20, the 8 and 20 period moving averages overhead are going to act as resistance right around the 14,000 level for the NASDAQ. So keep an eye on those short-term support and resistance levels in the coming days. Next up, let's take a look at iShares Mid-Cap Growth ETF. This is IWP. It's an exchange-traded fund that tracks the performance of the Russell Mid-Cap Growth Index. And we can see here that the growth index is actually showing more relative weakness than the NASDAQ. For the past 2 days, notice that the price action has slipped below the 50-day moving average and so far has not been able to get back above it. But on the other hand, notice that we've come into support of the prior base. That prior resistance of that base high should now act as support. So keep a close eye on the mid-cap growth index. We ideally want to see all of these indexes hold above their 50-day moving averages. Next, let's dive into three hot stocks that should definitely be on your radar for potential buy entry in the coming days. First up is Celsius, CELH. Look at this price action. Yesterday, CELH blasted 20% higher on 4 times its average daily volume. Monstrous volume there on a very bullish reaction to its quarterly earnings report. Now, if you're a new trader, you may be looking at this and thinking, well, it's too late. I already missed it. It already rallied 20%. What am I going to do with that? Actually, on the contrary, this is known as a breakaway gap, which often is in response to earnings reports. And the breakaway gap is actually one of the most profitable swing trading setups that we share with members of the Wagner Daily in the Morpheus trading service. And the reason it's profitable is because when you've got a breakaway gap to new highs, there's no overhead resistance and you've got strong volume and institutional support. However, that being the case, you can't just blindly buy because then you've got too much risk. There's actually several ways you can enter a breakaway gap that have relatively low risk. There's several different ways. And we wrote an entire blog post about that, how to trade the breakaway gap. And I'll be sure to leave the link for you in the comments. So check out the comments if you want to learn more about how to trade this breakaway gap. But this could definitely be setting up for a potential run of anywhere from 20 to 40% in the coming weeks. Now, of course, anything we say in any of our videos is not financial advice. This is simply what we see when we're looking at the charts. Next up is On Holdings, ONON. And we see that last month we had a breakout attempt here on strong volume above this prior high, but the breakout failed to materialize and the price action stalled. And it did come down and undercut the 20-day exponential moving average and formed a bullish reversal candle. But again, momentum has failed to materialize. So now we've got kind of a new base forming just above that prior base. And here's the thing. Next Tuesday is an earnings report. And this is a very similar setup to how CELH looked before they reported earnings. So you'll want to go ahead and be sure to check out that article about how to trade the earnings gap, because ONON reports earnings next Tuesday and could see a similar response to CELH. So if you see that type of a breakaway gap, you want to be prepared with how to profit from that type of trade setup with relatively lower risk. And the last stock on our radar right now is Arista Networks, ANET. Notice that recently ANET had a big breakout attempt on massive volume, 5 times its average volume. And you'll notice we talk a lot about volume because volume is the gasoline that powers breakouts. So we always want to look for confirmation of high volume when we see a breakout attempt. Now, ANET, because of a weak market, it failed to follow through with its breakout, but it also hasn't moved lower. In fact, we see a volatility contraction with the price contracting above the 8-period moving average right at the base. So this is a nice setup because if we get a rally above this base high, we could see a nice breakout, and this will be on our radar. As always, we will send a trade alert to paid subscribers of the Wagner Daily if we spot a potential trade entry point. In summary, we've got the NASDAQ and S&P 500 at inflection points that will determine their next move. But while the NASDAQ and S&P 500 are in correction mode, notice that these 3 hot stocks have been pretty much ignoring the market. That's the beauty of relative strength trading. Stocks that don't move lower when the rest of the market does are often the first to explode higher. So keep these 3 hot stocks on your radar. CELH, again, check out the tutorial on our blog for how to trade the breakaway gap, ONON and ANET. We hope you enjoyed this video. To find out more about our services, head on over to morpheustrading.com. On the homepage, you can drop your email address and get free trade picks every day. And if you'd like to receive our trade alerts and access to our exclusive MTG tribe in the swing trading chat room, be sure to sign up for the Wagner Daily service. See you back here in our next Morpheus Trading video.